Hey y'all, so I wanted to make a video talking about buying stocks. A lot of friends of mine have been telling me recently they've been buying stocks and they've got a Robinhood account and their Robinhood account recommended this stock and that stock and they're buying it. And I'm like, why would you buy a stock that Robinhood recommended without researching it? You gotta research it. There are some very, very simple tools online. I'm really just going to use Yahoo Finance because Yahoo Finance is accessible to everybody. It's super easy, and it actually is a pretty good. It's a pretty good platform for finance. I don't like their news or anything else, but their finance has some tools that nobody else really has, or at least not for free. And this is one of my first stops when I am researching a stock, not only because I'm used to it and familiar with it, but I just know how to navigate it, and there's some things in there that I'll show you right now that will tell you the health of a certain company. So I want to show you, let's just type in, you go to Yahoo Finance, and in the search bar you can really type in any company name or symbol. I'm going to just start typing in something everybody knows, Google, and click on it, and it's going to show you a little recap of a lot of the important numbers that people are interested in when they are looking to buy a stock or want to know how a company is doing. So this is their name, it's the parent company, and the stock symbol. This is the current price. Well, now the market is closed, but this is the price. If the market was open, this would be the current price that it's trading at, the amount that it's gone up today, the percentage it's gone up today, and here's the after hours changes. Then you come down here, and this is where a lot of the really important numbers are. Previous close, the open today, what people are bidding and asking for that. That's not as important. The range of the day, where the highs and the lows are of today. The highs and the lows of the last 52 weeks, very important if you want to compare it to where the stock has been. You can look at a chart as well for that. And then you come over here, and some very important numbers that I always look at is one, the P/E ratio, which is the current price divided by the earnings. So if you look over here, the earnings EPS, which is earnings per share, and this is the price of one share. So if you divide that, if you divide the current price by the earnings per share, you get the P/E ratio. And while that may not mean anything to you at the moment, but usually higher numbers over 10 are going to be when people consider that the stock is going to grow, and they're optimistic about where the stock is going. And then stocks under 10 for P ratio are usually they're still profitable. If the stock had no earnings or it had a loss, these would be they would say NA like this. So this means it's profitable, and it just means that a number under 10 would be kind of a stock that's kind of plateaued and it doesn't really grow much, but it's just kind of going along. And that's one of the first numbers I look at. I want to make sure that they have earnings. Then I come over here and look at the chart for the stock. And I'm going to open it up. You hit full screen over here. Yahoo Finance actually has fantastic charts. There are many different companies you could find charts at, but charts are very important. You want to look at where it's come from. Obviously now, I'm going to go to the year to date, and that's what I've been doing during COVID-19 because it shows me really everything I need to know. and it shows, here towards the end of February, it started selling off. But these are the highs right before the sell-off, and you can see it will show you once you hover over that spot, it will show you the numbers from that day. So it shows you a high of 1520, 1530 about, and then you see it sell all the way off, and that's, by the way, this is the blue line over here. The reason why I have two lines, and that's something else I wanted to talk to. The blue line is Google, and then the red line is the S&P 500. And I always compare, that's my basic comparison. You can go right here and you can add any, they give you the option of adding the three major indices, or you can put any symbol that you want to compare. Let's say you want to compare it to Facebook. See, well, how's their price been doing compared to Facebook this year, what looks better. So you see the S&P 500 went down over this period of the year to date. The S&P 500 went down 8.5%. Google went up 3.4%, and Facebook went up 6%. So, and those are the basics. You can add a lot of other things. This is the volume, how much is trading in the stock on an every day, and which way it was headed during that day. Green means it's going, it was mostly buyers. Red means it was mostly sellers. And that's the basics. But what's really important when you're buying outside of a time like this is really just to look back maybe a year or 2 years and just see how the stock's been doing. Has it been going up? Has it been going down? If it's going down, maybe you want to know why has it been going down, and really, do I want to buy this stock? See what the news was a few months back when it started going down. As you can see, Google's been Google, I'm going to get rid of the comparisons right here. You can X these out just by going like that, and you can see over 5 years. For 5 years, Google has been steadily going up, and that's a good sign. Now, I'm going to go back. I'm going to show you some other things that I like to look at. Here's some stocks that people look at that are similar. It's a good thing to have there. I sometimes see things over there, stocks over there, and I'm like, oh wow, what is that? And I click on it, and then I find a stock that I've never heard of, and maybe I buy it. This box here is very important. It shows you the last 4 or 5 quarters, and it shows you what their earnings were compared to what everybody expected their earnings to be. So you can see over here, their actual earnings were $14 a share, and the estimate was $11 a share. In this column, you see there was a surprise lower amount. They had $10 actual, and people expected it to be $12 a share of earnings. And so that's very important. You could see, how they're doing compared to how people expect they were doing. This is one of my most important things that I look at right away. It's not always 100% accurate. I still go and look at the financials, but this shows you the last 4 years, or you can choose the last 4 quarters. It shows you how revenue, which is the gross sales, and how much the net income, the earnings, have gone up over time or gone down over time. And you can see Google has very healthy growth, and their earnings are very healthy as well, and for the most part have been going up. And if you see something there that you sometimes, like you can see over here, you had 90 billion in revenue and 19 billion in earnings, and then the next year you had a $20 billion increase in revenue, but but earnings went down to 12 billion. Why did that happen? And that's another reason why you would go to the financials, and I could show you that soon and tell you some reasons why it might go down. Nothing really to worry about. Obviously, they have very healthy financials. Down here is the recommendations from brokers, big companies like Citigroup and UBS, and they're going to give their recommendations on whether you should buy it, hold it, or sell it. And as you can see here, so they have 43. This is actually the other way around. This goes from left to right. You see 2016, 2019, and then over here you see it's going this way. It's going from right to left. This is the most recent column, and you see 13 analysts say strong buy, 25 said buy, and 5 said hold. And this is out of 5, 1 being the strongest, 5 being to sell. It's a 1.8, which is very good. Down here, you have analysts' price targets. So this is where they expect the stock to go. You have the current price, you have the average of the analysts, what they said, the low and the high. And then down here, you show the specific companies and when and how they changed their, or didn't change. These are all maintained. They kept their same rating, every period. And then here's a little bit about the company. I find that very important, especially now. You may understand what the stock does in general, but you may not know all the specifics, and to read what they're doing, you might not be interested in a stock that, say, has something to do with travel right now because nobody's traveling. You want to understand what they do. What is their business? I did forget to go over one thing over here. I wanted to show you how you can see the quarterly earnings over here. See, they have decreased a little bit in the first quarter of 2020 because of probably because of COVID-19. I did want to say something specifically about now. A lot of stocks, a lot of companies are writing down assets because they're expecting losses during this period. They're expecting there's unexpected losses, and they may be recording losses on their books for COVID-19 or expected losses. And that sometimes with some of these companies is the reason why they may have a lower number this period, because they have accounts for expected accounts receivable. They have a certain portion that they expect to be uncollected, something similar, and they're writing it down. That doesn't mean that it's actually a loss. It just means that they're taking a loss because they're expecting it to happen based on prior history. Over here is the news. Very important to read the news, see what people are saying about stocks, see what, sometimes it's people are just, kind of speculating about where the stock's going to go and whatever. But sometimes there's some really important news like this. Google will likely be charged with antitrust lawsuits from the DOJ. That could be very important. And then, then there'll be like speculation of where Google's going. So you might want to look through, before you buy a stock, you might want to look through that quickly and see what the stock is, what's going on with the company. Now, on top over here, there's a bunch of different sections you can click on. My next step is financials. Financials are very important to me, especially now. And I'm looking on here for one key piece. But first, I'm going to show you a little bit about some of the basics. Here's the income statement. All numbers on the income statement, balance sheet for pretty much all companies, I think, are in thousands, so you're going to add 3 zeros to the end of that. Now, some of the things that I look at in general when I'm looking at a financial statement is here's their total revenue, what they brought in for the year, or you can click over here to see quarter. Actually, I want to see what quarterly is, because now you can see the COVID-19 effect, how it's gone down. So this is their total revenue. This is their cost of revenue. Cost of revenue is items that are directly associated with their line of revenue. So they run Google. They sell ads. So their selling of ads is probably what they consider cost of revenue. And that's very important, because the cost, you want to see a healthy number, a large gap in between these two numbers, because if the cost of revenue is the same as the revenue, then it doesn't matter how much more sales they have. If the incremental cost of selling that is going to be the same, then they're never going to make money. But if there's a healthy difference, then all they need to do is get to a point where they're covering their other expenses, their general and administrative expenses, and then they're making money. And that's why these numbers are very important to look at. You want to see how they're doing compared to other companies, and you can do all sorts of comparisons, but you want to see how they're doing financially and what they're doing compared to either previous years or previous quarters. And then this is going to show you have all sorts of different numbers. It comes down to the earnings per share, their basic earnings per share, and then their total, net income from continuing operations. And then if you see over here, they have unusual items, and that's what I was talking about before. A lot of times these companies write off sectors or whatever they're doing, they may be writing off, or it might be COVID-19 related. You can look in the news when they came out with their financials and see what they said about, what is this unusual item, and then consider whether that's important in your decision whether to buy a stock or not. On the balance sheet, and this is extremely important, this is one of the first things I do right now in a down market. You want to make sure that companies have the ability to pay off their bills. And the easiest way to see that is to see what is their current assets and what are their current liabilities. So their current assets, I'm going to break it out a little bit more than that. Their current assets, $152 billion. They have $119 billion in cash. They have $25 billion in receivables. That means it's money coming in, hopefully coming in. Then they have inventory and other current assets. So usually cash, to me, in a downturn, I'm going to expect that a portion of these receivables are not going to come in or not going to be useful to pay off debt. So let's say I'm going to take maybe 120 billion plus, actually let's go to the current quarter. It's a more updated number. And let's see again, we have cash. So we have cash and cash equivalents, which is 117. Let's round that up to 120. Plus another 20 of, let's say half of that, so 10 of receivables. They have 130 billion in money that they have available to pay off their debts, their expenses in the near term. So then you want to go look at their liabilities. So their liabilities, their current liabilities, are 40 billion, which means that they have basically 3 times, maybe even more, their current liabilities in available cash and to pay off their liabilities, which means that's very healthy. That's extremely healthy. And it means that you don't have to worry about it because they can go a couple of quarters with a big loss and they'll be fine. And that's where I want to segue into maybe a different stock. Maybe people are something to the complete opposite side of the spectrum. Google's a healthy company. They're doing good right now. They're selling ads. People are at home watching Google. But what about a travel company that has no business right now? What about, let's see, United. Or, yeah, let's go to United. Let's see what United looks like. So, United, so you remember, Google had a P ratio of like 27. United has a P ratio of 6, way, way lower. Now, that means that that stockholders, they're still profitable, or at least they were as of the last quarter, but stockholders are not as confident about their stock as they are about Google, which is why it's trading at this price. And you can see that the reason why people would be buying this is because it's $20, and they had basically $4. They have $4 in earnings. Now, well, that doesn't mean the next quarter is going to still be that amount, but assuming that things get better, an optimist would be saying, well, I can buy this for $20 a share, and I'd be getting my money back in about 5 years. It's a 20% return, which is fantastic, and that's if the stock goes up. And so, you also, another thing, and I didn't talk about this before, is you want to also look at dividends. Dividends are very important. You want to see what the forward dividend, and I'll show you a different stock that maybe has dividends. But this is the forward dividend and the yield. The forward dividend would be the amount of the dividends per year, and then the yield is the percentage of the price of the stock. So if it was $1 per year, this would say 5%. And then you can look at a chart where Google was, selling at near its highs. You can see over here, United is selling near its 52-week lows. Its 52-week range is $17.80 to $96. It's now selling at $24, so it's very close to the bottom of its 52-week range. And if you look at the chart over here, I'm just going to open up a small chart. You can see before the downturn, it was selling at $80, and now it's selling at $24 today. And that's less than a third of the price. You can also look over here, and if you go to their quarterly, you see there's a huge difference in between the revenue from last quarter to the revenue from this quarter. And please take into account when you look at these first quarter earnings for 2020 that the company has only had people only started to stop traveling in March, really, and that's only 1/3 of the quarter. And even though it was only 1 month of down, it went from 11 billion of revenue and 640 million in earnings to 8 billion in revenue and negative 1.7 billion in earnings. And this is for a company that, if you look at, and that's why it's very important to look at the quarterlies, because the annuals show it's just going up. It's kind of like Google. It's not as good as Google, but the earnings are growing up and the net income's going up. And but if you look at the quarterly, all of a sudden you see a huge dip, and you got to consider that when you buy this stock and think about, hey, is this stock going to be good? If they have another quarter like this where nobody's traveling, what's that going to look like? That might look like 4 billion and a $3 billion loss. And let's look at their financials. Can they pay off their debts? Let's see. Go right to their balance sheet, and you look at their balance sheet, and they have cash of and net receivables, let's put that at 6. Let's be optimistic and say they have 6 billion of cash and net receivables, and they have current liabilities of 15 billion. 15 billion. And it's almost 3 times what they have available to pay off those current liabilities. And what will happen, and why you see these companies going bankrupt, there's been a few companies that have announced bankruptcies recently, is because they ran out of cash and they went to the bank and they said, hey, can you give us more time? Can you restructure our debt agreement with you so that we can pay it off? We can get a little bit more cash now and be okay for a couple of more months and ride this out. And the bank said, no. And then they went down the street to another bank, and that bank also said no. And then they were like, ooh, we're in trouble. And then they did that a few more times, and then the bank came a few days later, came knocking on the door and said, hey, you know, your payment this month is due. And they're like, we don't have any money. And so they declare bankruptcy. And that's what happens. So it's very important to look, especially right now, to look, any company, you buy their stock, look at how much cash they have, look at their current liabilities. Just make sure that it's a good stock. And you can look at any stock up on here and it'll tell you the same information. So I encourage everybody who's buying stocks right now to go out and look and make sure that what they're buying is a good investment. And if you want to buy a riskier stock like United Airlines, go ahead. Just understand what the risks are and understand that you're hoping that, yes, everybody's going to start traveling again. I hope y'all enjoyed this video. If you have any questions, you want me to explain something further or explain something else about financials or accounting or anything like that, let me know. If you liked the video, please share, plus press the like button, and maybe I'll put out some more of these videos. Thanks a lot for watching.